Have you ever wondered how Vladimir Putin's insane oil plans with Saudi Arabia could potentially end the US dollar? As one of the world's largest economies, Russia has the potential to cause a major shift in the global economy, and this is exactly what they are aiming for. With an alliance between Russia and Saudi Arabia, it looks like these two countries have the power to disrupt the US dollar's long-term dominance. In this video, we'll explore why Putin's plans for oil could seriously put an end to the US dollar as the world's reserve currency, and how by striking a deal with Saudi Arabia and other OPEC nations to freeze production levels of crude oil, Putin hopes to create a more stable and predictable market for oil. We'll also look at how these two countries have the potential to reshape global markets and potentially create a new economic order. Are you ready to join us on this incredible journey? Then hit that subscribe button and don't forget to click the bell icon so you can keep up with our latest content. Let's explore some amazing things together. So what are Putin's plans and how could they affect the US dollar? Let's take a closer look. Starting off with what is OPEC and how it controls oil prices. OPEC, or the Organization of the Petroleum Exporting Countries, is an intergovernmental organization made up of 15 oil-producing nations. OPEC's mission is to coordinate and unify petroleum policies between member countries in order to ensure a steady supply of oil at reasonable prices. About 44% of the world's oil is produced by the 15 OPEC members, who also control more than 81.5% of its oil reserves. OPEC also works on various initiatives toward promoting economic stability and security in the world by maintaining an efficient and regular supply of oil to consuming countries. OPEC accomplishes this through managing production quotas and setting prices for its member countries, as well as engaging the negotiations with other non-member exporting nations to reach agreements on the levels of production and pricing. OPEC also has a big impact on the global economy. Oil is a major export for many countries, and it plays a big role in the world market. When OPEC decides to cut production, it can cause a major economic downturn. In July, Joe Biden visited Saudi Arabia and embraced Mohammed bin Salman, the country's crown prince. Biden had pledged to declare Saudi Arabia a pariah because of its 7-year war on Yemen and violations of human rights as a presidential candidate. The unexpected invasion of Ukraine by Russia and a deadly global pandemic, however, obliged him to put these worries to the side in favor of realpolitik. Biden suppressed his ego and treated the prince like the global leader he wished to be because he wanted the Saudis to raise oil output in order to cut fuel prices for American consumers. Regretfully for Biden, that humiliating fist bump photo opportunity has completely backfired. The Saudi-led OPEC and energy cartel decided to reduce oil production by 2 million barrels per day, which will result in higher fuel costs. The Biden administration spent a lot of political capital trying to convince Saudi Arabia and its allies not to reduce production in the days before the vote. In the end, Biden's courtship of Prince Mohammed resulted in nothing more than a 2% increase in global oil production. A little prior to the U.S. midterm elections, the prince really hurt the Biden administration politically. The actual fall is expected to be between 1.0 and 1.1 million barrels per day as a result of sanctions on OPEC countries like Russia, Venezuela, and Iran, as well as production problems in Nigeria and Angola. The price of gasoline in the U.S. decreased for more than 3 months after rising nearly $5 per gallon in June. They have recently increased by an average of 12 cents per gallon over the past week to $3.92 and are now rising once more. A barrel of crude oil costs about $79 at the beginning of the year. 2 weeks after Russia invaded Ukraine in March, it topped $127, reaching its highest point in 14 years. In countries where oil is purchased with US dollars, increased oil prices are resulting in higher inflation and living expenses. The United States has been significantly impacted by the reduction in output. The resulting increase in inflation may decrease U.S. President Joe Biden's already low approval ratings. The U.S. and U.K. economies are having problems as a result of OPEC's decision, which is absolutely against their interests. Furthermore, the measure might make things more difficult for regions like Europe. Although many European governments have established a cap on the price of Russian oil, Putin has threatened to prohibit Russia from selling to those countries if the cap is enforced. As OPEC's reductions might also prevent attempts to stop providing oil to Moscow after its invasion of Ukraine. The bilateral relations between Saudi Arabia and the U.S. are being strained by this entire issue. Saudi Arabia is a significant ally of the United States in the Middle East. For many years, American weapons, training, and service support have been a necessity for Saudi Arabia's security forces, ostensibly as a counterbalance to Iranian military dominance in the region. Because Biden can't get past the long-standing U.S. policy of backing the House of Saud, Prince Mohammed had clearly come to the conclusion that he could get away with maintaining high oil prices and undermining the U.S. and EU campaign to isolate Russia while still receiving U.S. protection and military support. However, Prince Mohammed has now challenged the long-standing consensus. And to make matters worse, he made that choice only 1 month before crucial congressional elections, when Washington and its allies are attempting to keep a united front against Russian aggression. The current system of dollar supremacy in oil pricing and trading dates back to 1974, following the turbulent events of the Arab oil embargo, the 1973 oil crisis, and the abandoning of the dollar's link to gold and its fixed exchange rates to many other currencies in 1971. Saudi Arabia consented to market oil in dollars and hold some of its reserves in treasury bonds in exchange for U.S. military and political support and purchases of its oil. Various other oil exporters did the same. The Saudis continued to tie the value of their currency to the U.S. dollar. The Mideast Gulf oil states prospered under those petrodollar agreements. The U.S. was able to finance large trade deficits with ease, and a generally strong dollar encouraged the export of manufacturing from the U.S. to China and other countries by making U.S. goods relatively expensive. In the extensive chains through which oil slowly flows from the wellhead to refineries to end customers, complicated systems for price discovery and techniques of hedging physical and financial risks emerged inside the oil trade itself. Many people began to view this market as justification for the dollar's continued dominance in the oil industry. Markets offered a variety of services that couldn't be rapid, if at all duplicated, and were deep and liquid. The circumstance could evolve over time. In terms of the economic diversity needed for the energy transition, a lower value Saudi rial would be advantageous if the Saudis gave up their currency's relationship to the dollar, along with the dollar oil price. In reaction to the Saudi maneuvers, Biden has so far offered vague consequences. However, an increasing number of Democrats in Congress, even centrists who were hesitant to break off the alliance despite the kingdom's appalling record of human rights, are now calling for action. On October 10th, Democratic Senator and chair of the influential Foreign Relations Committee, Bob Menendez, called for an immediate halt to all aspects of our cooperation with Saudi Arabia and pledged to obstruct any further U.S. arms shipments. Even stronger criticism came from the second-ranking Democrat in the Senate and fellow moderate Senator Dick Durbin, who wrote on Twitter that the House of Saud has never been a trustworthy ally of our nation. It's time for our foreign policy to imagine a world without their alliance. The U.S. stands to lose a lot more than Saudi Arabia. It might lose the simplicity with which it finances its large national debt. Another casualty would be its unrestricted capacity to impose unilateral sanctions on foreign nations. In the politically tense nation, the loss of prestige is also nothing to laugh about. Although it takes time, domestic industrial recovery could lessen the damage by reducing the trade deficit. It's time for Biden to renounce the Oil for Security agreement and admit that his purportedly realistic strategy for Saudi Arabia has failed. The partnership between Vladimir Putin and Saudi Arabia in pursuit of oil plans has the potential to disrupt the U.S. dollar's dominance. If the two countries manage to successfully implement their plans, then it could lead to an erosion of economic power for the U.S. currency and make it less appealing as a global reserve currency. While this is certainly a long shot, it does demonstrate the need for caution and vigilance when considering how U.S. economic policy could affect global markets. In any case, this partnership between Putin and Saudi Arabia is sure to be closely watched by investors around the world. Only time will tell whether or not it will have an impact on the U.S. dollar's standing in the global economy. This brings us to the end of the video. So, what do you think will happen? Will the U.S. dollar remain as the global reserve currency, or will it be replaced? Share your opinion with us in the comments section below. Do consider liking and subscribing to our channel for more interesting videos like this, as it helps immensely in providing you with quality content. Thank you for watching. See you in the next video.